Most people with pensions think they're safe, but one single mistake can cost you hundreds of thousands of dollars over the course of your sunset years. You've worked for decades, putting in the hours and the sweat, all for that promised gold watch and a guaranteed check every month. But here is the cold, hard truth. The pension landscape in the United States is shifting, and what worked for your parents might leave you broke. Especially number 3, almost nobody plans for it until it is far too late to change course. If you are counting on a pension for your retirement planning, you need to hear this right now before you sign a single document. Before we dive into the traps, let's get some quick context on what we are actually dealing with. A pension is what professionals call a defined benefit plan. In simple terms, your employer promises to pay you a set amount of money every month from the day you retire until the day you pass away. It sounds like the ultimate safety net, the dream of a stress-free retirement, where the checks just show up like clockwork. However, the gap between that expectation and the modern reality is widening every year. Many workers assume their pension income is a locked door, but in reality, that door has several sets of keys held by people who aren't you. By the end of this video, you will know exactly how to protect your income and avoid the biggest retirement traps that catch thousands of Americans off guard every year. The first thing you absolutely must know is that your pension might not be as guaranteed as you think. Most people assume that because a company or a state entity promised them a check, that check is written in stone. But history is littered with stories of employer bankruptcy and underfunded pension plans. When a company falls into financial ruin, their pension obligations are often the first thing they try to restructure or shed. Now, there is a safety net known as the Pension Benefit Guaranty Corporation, or the PBGC. This is a federal agency that steps in when private sector pensions fail. But here's the catch: the PBGC has limits. If your promised pension is higher than their maximum coverage, you could see a massive haircut in your monthly income. Imagine planning your entire life around a $3,000 monthly check, only to have it suddenly drop to $2,000 because of a corporate bankruptcy you had no control over. This isn't just a corporate issue either. Many state and local government pensions are currently facing massive underfunding gaps. Do you actually know how healthy your pension fund is? Have you looked at the annual funding notice that they are legally required to send you? If you haven't, you are flying blind. This uncertainty gets even more complicated when you realize that even if the money is there, the government is going to take their cut before you can even buy a gallon of milk. That leads us directly into the second critical point. Taxes can quietly destroy your pension income. Many people spend their whole lives thinking about their gross income, but in retirement, the only number that matters is your net income. Most pension income is considered ordinary income by the IRS. This means it is taxed at the same rate as the salary you earned while you were working. But the real danger lies in the stacking effect. When you reach a certain age, you aren't just receiving a pension. You are likely also collecting Social Security benefits and perhaps taking required minimum distributions from a 401k or an IRA. All of these income streams stack on top of each other, which can easily push you into a much higher tax bracket than you anticipated. You might think you're getting $4,000 a month, but after the federal government and potentially your state government take their slice, your actual spending power is much lower. Let's look at a quick contrast. Take two retirees both receiving the same $50,000 a year pension. One lives in a state with no income tax and has managed their withdrawals to stay in a lower federal bracket. The other lives in a high-tax state and is forced to take large IRA withdrawals that trigger a tax torpedo, making their Social Security benefits up to 85% taxable. These two people have the same pension, but completely different qualities of life. This is why retirement planning isn't just about saving, it's about tax efficiency. But even if you handle the taxes perfectly, there is a decision looming on the horizon that can make or break your entire financial future. This brings us to the third point, which is perhaps the most stressful part of the entire process: the lump sum versus monthly payment decision. When you retire, many pension plans will offer you a choice. You can take a lifetime of monthly payments, or you can take a single large lump sum of cash right now and walk away. This is often a one-time, irreversible decision. If you choose the monthly payments, you have the security of a check that you can never outlive. No matter how long you stay on this earth, that money keeps coming. However, you lose control. You can't take out a big chunk for an emergency, and when you pass away, the money usually stays with the company unless you've selected specific survivor options. On the other side, the lump sum gives you total control. You can invest it, grow it, and leave it to your children. But you also take on all the risk. If the stock market crashes or you spend too much too fast, you could run out of money while you're still healthy. Key factors like your current health, your life expectancy, and current market interest rates play a massive role here. When interest rates are low, lump sum offers tend to be higher. When rates are high, they usually go down. It is a high-stakes math problem that requires you to predict the future of your own health and the global economy simultaneously. And speaking of the future and your health, this is where most people make a devastating mistake regarding their family. The fourth thing you must understand is how survivor benefits can make or break your family's future. Most pensions offer two main paths, a single life option or a joint and survivor option. The single life option pays you the highest amount of money every month, but it comes with a massive catch. The moment you pass away, the payments stop. Your spouse gets nothing. The joint and survivor option, on the other hand, provides a check for as long as either you or your spouse is alive. The trade-off is that your monthly payment will be lower while you are both living to account for that longer potential payout period. It is an emotional and financial tug-of-war. We see real-world consequences of this every day. Some retirees, focused only on the biggest possible monthly check, choose the single life option without fully discussing it with their partner. Then, they pass away unexpectedly, and their spouse is left with a massive hole in their budget, often losing most of their household income overnight. Choosing the right survivor benefit is about protecting your loved ones, not just maximizing a spreadsheet. It is about ensuring that the person you spent your life with isn't left in a financial crisis while they are grieving. We must discuss inflation risk to help you plan for retirement, the silent killer of pension income. Most U.S. private sector pensions lack a cost of living adjustment, or COLA. If your pension is $2,000 today, it will be $2,000 in 20 years. Compare what a dollar bought 20 years ago to now. Your fixed pension will lose half its purchasing power in 24 years if inflation averages 3%. A fixed pension that's comfortable at 65 may leave you poor at 85 if you don't have equities or real estate. Consider that your healthcare costs will rise while your pension payment stays the same. We'll do a quick overview of today's topics because they're crucial to your financial survival. First, monitor your fund's health because your pension is only as robust as its payer. Second, Uncle Sam is your pension partner, and taxes will reduce your net income. Third, choosing between a lump amount and a monthly check is a lifelong decision that demands careful consideration of your health and ambitions. Fourth, never overlook survivor benefits. Your pension should protect your family, not just you. These are major blunders that damage your retirement. The earlier you plan and examine these figures, the more possibilities you have. Hit the like button and comment "pension" below. If you're a pensioner or planning to be one, to let me know how many of you there are. Sharing information about retirement planning is one of the most important things you'll ever do and benefits everyone. If you like this breakdown, subscribe to avoid missing our next financial security deep dive. Good information leads to a successful retirement, and you're ahead of the curve by watching this. Keep preparing, learning, and see you next time.